Alright guys, so today I'm going to be discussing why I predominantly concentrate my portfolio as opposed to diversify my portfolio. Now this is my own personal strategy. I would advise you to do your own due diligence, but I would watch through the whole video because it probably will be one of the most insightful videos and most information-packed videos you ever watch. Now there's a quote from Warren Buffett, a lot of you have heard this. It's diversification is protection against ignorance. Now just think on that for a second. What is the definition of ignorance? It's the lack of information or knowledge. And so what he's trying to say is, if you diversify your portfolio, you're protecting your own self from a lack of information. Now just dabble on that for a second. Moving on to the next quote from Charlie Munger. The idea of diversification makes sense to a point. If you don't know what you're doing, and you want the standard result and not be embarrassed, why of course you can widely diversify. Nobody's entitled to a lot of money for recognizing that because it's a truism. It's like knowing that 2 and 2 equals 4. But the investment professionals think they're helping you by arranging diversification. An idiot could diversify a portfolio, or a computer for that matter. But the whole trick of the game is to have a few times when you know that something is better than average and to invest only where you have that extra knowledge. So what he's trying to say is, to lean it out and cut out all the fat, he's trying to say that concentration is designed for growth, whereas diversification is a form of preservation. In other words, it's lower risk to diversify and so you get lower rewards. There's a saying, scared money doesn't make money. If you're going to be receiving a smaller accumulation in capital gains due to diversification, that means you must have a lot of money. The big mistake that I see from a lot of people starting out or who are quite intermediate, they begin diversification even though they don't have a lot of wealth, and that's going to take a huge amount of time. If you look back on Warren Buffett and Charlie Munger's history, they initially were very concentrated in 2 stocks, and they built their wealth on that until the point those stocks got so huge they then had to diversify. But that's how they initially built their wealth. So let's just take some advice from the experts here. Moving on to my next point, long-term investing statistically outperforms short-term trading, as no one can definitively predict stock price in the short term. You can infer via patterns, but nobody's got a crystal ball. And so to sum that all up, that means the wealth from the impatient goes to the patient because they've held on to those shares. That's another quote from Warren Buffett. Now, this video was inspired by Chicken Genius Singapore, and he states, the amount of money you earn is directly proportional to the size of the problem you solve over the long term, which is a fundamental truth. If you look at all big companies in the last 10 years, they are solving a problem. Now, the bigger that problem, the bigger the reward. Hint, hint, why I'm invested in Tesla. What is the problem that Tesla fixes? Sustainable energy. That's a big problem. Now let's look at the sister companies of Tesla. Let's look at the Boring Company. What does it fix? It fixes traffic congestion in big cities. That's a really big problem. When I'm going to work, I'm waiting an hour in line, queuing up. If there's a way to mitigate that, of course you're going to make big money. Let's look at Neuralink. What does it fix? Now, Neuralink is probably one of the most underrated companies in the world because it fixes one of the biggest problems. It fixes damages to the brain, sustained injury to the brain firing off neurons. It can possibly fix dementia, spinal damage, paraplegics. The list goes on. This is a big problem. So if it works, it's going to make a lot of money. That's just a fact. SpaceX, what does it fix? It fixes if the Earth is unsustainable. So if Tesla fails, making humans an interplanetary species, that's what it fixes. So of course it's going to make a huge amount of money. You can see there's a pattern here when it comes down to Elon Musk's companies. He's asking himself, what is the problem I can fix? And these were the problems he came up with. So if you're wanting to invest in companies, I would primarily aim for the ones that fix the biggest problems, because that's going to give you the biggest return. I'm glad you enjoyed this video, hopefully. If you would like to discuss it, feel free to comment below. This is only my opinions. You have to keep in mind that you have to implement your own risk factors associated with this. In my eyes, the younger you are, you're able to take more risk. The older you are and you're close to retirement, you can't take as much risk because that might not pay off. You know, you might lose a lot of money. I primarily concentrate my portfolios over diversification for that growth. In addition to that, I don't do any dividends. Why? Because I think that dividends should be used to grow the company, not to pay out shareholders. The benefit to the shareholders is the capital gains associated with the growth. That's far outweighs any dividend that you can receive. I mean, compare Tesla to like BP or Shell. I mean, come on, there's not even a comparison. They pay out dividends, and yet a lot of people would want the Tesla shares a lot more than BP and Shell. So just think on that. You have to really sit down. What is my risk tolerance? What is my age? Am I wanting to retire soon? Can I take more risk? Can I take less risk? Determine what your goals are. Find your strategy and implement. Now, my strategy is not going to work for all of you, but I think a lot of you will agree with it. I hope you enjoyed it, and have a good day.